Okay, great. Now let's talk about owner's benefits. This is not just the pre-tax lifestyle. This is actual benefits. Well, number one, health insurance. You want to do that, and if you have an S corp, it's got to go on your W-2, box 1 and box 14. Very important. This is missed so often. It's a dumb rule, but it is a rule. So if you own more than 2% of an S corp, your health insurance, no matter how you're paying for it, if you want to deduct it, put it on box 1 and box 14. And that's whether it's a group plan or individual plan. If you're paying for it out of personal funds on an individual plan, have the company reimburse it and get it on there, and you can take the deduction. Okay, next, life insurance. It's not deductible, but it's definitely something you can pay for from the company. Also a good thing to pay if you have a C corp, pay it from there. Great use of those funds. The health insurance, you can reimburse last year's and get it on your W-2 in the next handful of days. If she's going to reimburse her health insurance for 2018, and you've already sent your W-2s, then what you can do is amend your W-2s, reimburse it, get it on your QuickBooks, and get it on, amend your W-2s. And unfortunately, it happens all the time. Yep. Okay, question on long-term care insurance. You definitely can deduct that. Now, if you pay for it out of your S corp, your deduction is limited based on age. They've got a table for it, and it's got to go with the self-employed health on your W-2. If you pay for it out of a C corp, you get to deduct all of it. So long-term care is always significantly better out of a C corp. Life insurance in a profit-sharing plan is tax neutral, so no issue there. If you're a physician or something like that where you are heavily involved in the production of income, disability insurance is crucial. Well, the IRS actually ruled on another method, which is incredible. It says pay for it personally. Don't deduct it in that year that the policy is in force. Disability insurance is generally a 12-month policy. Then after the policy expires, meaning the following year, submit it to the company for reimbursement. You can deduct it then a year later, and you will never get taxed on the benefits because you got reimbursed for an expired policy. Yeah, so the question is, do you actually reimburse yourself? Yeah, what you do is you actually get a copy of the little premium page from the prior year, and then you turn it in under an account expense reimbursement plan. And so you turn it into the company, and the company reimburses you just like it's reimbursing you for, if you bought something with personal funds one time. Expense reimbursement plan. Okay, one other really fun one. This is one of the free lunches in life. The IRS has ruled that you can have, any of those credit cards that's generating frequent flyer miles, and you can generate all those frequent flyer miles with business, deductible business expenses, and then use those frequent flyer, cash those in and use them personally with no tax effect. So that's tax-free use. This means you can run up millions of dollars a year in frequent flyer miles and take your family to Europe, and that is absolutely tax-free. So my advice is do it. Yeah, now then the next question is, now they've got these cashback programs. That is not tax-free. And so cashback comes in a couple things. It either gives you a statement credit, reduces the amount that you're paying on that credit card. It just means you're deducting less than expenses paid. So it's kind of taxable that way. Or if you're getting those cash cards, those are taxable. But the miles, you're good to go.